Seatrium's profit doubled. OUE REIT's yield reached 6.19%. Singapore Airlines just posted record passenger numbers. On paper, all three look like buys. Underneath, one clears my forensic filters, one fails outright on cash conversion, and one I genuinely cannot rate yet because my own sources contradict each other. If your retirement income depends on getting this right, the headline is the least useful number on the page. Looking at our overview, we are applying our non-negotiable forensic filters directly to Seatrium OUE REIT and Singapore Airlines. Mainstream financial journalism is heavily promoting these names right now, moving stock prices based entirely on top-line press release summaries. But when you look beneath the surface, one name clears my balance sheet test easily, one fails completely on cash conversion, and one remains wide open under review until we can verify conflicting distribution data. The core problem in the current market is that broad headline expansions create a dangerous illusion of safety. The risk for retail investors is that buying into these media narratives exposes your retirement capital to silent structural deficits and hard threshold breaches that never make it into the front page news. Our approach today is simple. We strip away the noise and look at the raw numbers to see exactly where the top-line performance flattens out. Let's be clear about who this analysis is built for. If you are chasing short-term growth and momentum, a higher risk profile might clear your personal hurdle. But if you are a retiree focused on wealth preservation and dependable drawdown income, my forensic standard exists to protect your capital from uncompensated operational risk. And this is not theoretical, it has real consequences for your monthly expenses right now. The newly hiked July 2026 household electricity tariff sits at 34.78 cents per kilowatt hour, inclusive of GST, which means your portfolio cash must be real, not an accounting adjustment. You cannot pay your utility bills with paper profits. Turning to step 1, we execute our financial health check, focusing entirely on solvency, and this is exactly where the dividend math breaks for two of these three names. Seatrium passes gross gearing at 0.57 times, but fails my interest coverage ratio floor, coming in at 3.03 times against a benchmark of 4 times. OU REIT fails on both fronts, with gearing at 36.6% and interest coverage at a weak 2.6 times. Singapore Airlines clears easily, with gearing at 24.5% and an interest coverage ratio of approximately 7.2 times. These health check metrics lead directly to our formal forensic zone assignments. Seatrium lands squarely in Zone 5, which is the red zone, reflecting severe structural weaknesses. OU REIT's zone assignment is currently under review due to data conflicts we will address shortly, while Singapore Airlines is placed in Zone 4, representing caution. To understand how these classifications work, every single stock I track receives a forensic zone rating running from Zone 1 Fortress, representing retirement-grade safety, down to Zone 5 Red Zone, which signals a severe structural red flag. We rate names based on trailing yield, gearing or capital strength, the interest coverage ratio, and weighted balance sheet flags. Elite investors receive the full forensic rationale, soft flag breakdown, and zone trajectory commentary for every covered stock. Moving to step 2, we conduct a wealth check. Because let's be honest, paper profits do not pay for your wet market groceries. Seatrium gives us a trailing yield of just 1.52% based on a 3-cent ordinary dividend, failing our hurdle. OUE REIT shows a headline 6.19%, but its ordinary component is heavily disputed between sources and remains under review. Singapore Airlines shows a total yield of 4.83%, but the ordinary portion is just 3.53%, with the rest coming from a 1.30% special dividend. To evaluate these yields properly, we use the stress test buffer. I apply a conservative forensic floor of 3.2% because we audit for the storm, not just the sunny day. With the 6-month T-bill sitting at approximately 1.48% as at the most recent completed auction, I refuse to lower my standards to match a temporary market dip. My minimum yield hurdle stays at 4.7%, representing that 3.2% floor plus a mandatory 150 basis point risk premium. Let's dive deep into Seatrium Limited. The annualized distribution stands at 3 cents against a current closing price of $1.98, placing the yield at a thin 1.12%, failing both our 4.7% hurdle and the 3.2% floor. Total revenue scaled 24.3% year-on-year to 11.5 billion Singapore dollars, and net profit doubled to 323.6 million, but the cash conversion tells a completely different story. The true cash gap becomes obvious when you look at unadjusted free cash flow, the cash left after operating expenses and maintaining capital assets, which sits at a razor-thin 19.7 million Singapore dollars. With 3.4 billion shares outstanding, That 3-cent dividend commitment demands 102 million Singapore dollars in cash. This creates an $82.3 million shortfall, funded partly by legacy settlement drag rather than core operations, while interest coverage sits at 3.03 times, below the 4 times floor required to trust balance sheet resilience. This cash commitment deficit table illustrates the stark reality facing the company. On a reported profit basis, the net profit of 323.6 million Singapore dollars suggests a comfortable surplus of 221.6 million dollars over the dividend requirement. But on a true cash basis, the available free cash flow of 19.7 million leaves the company facing a stark cash deficit of 82.3 million dollars to fund its payout. Seatrium looks like a spectacular turnaround story on paper because accounting profits have surged. But an engineering giant cannot pay tangible dividends with paper profits when unadjusted free cash flow is pinned at 19.7 million Singapore dollars and interest coverage sits below my 4 times floor. This is not a single gate miss. Yield fails the 3.2% floor outright. Coverage fails independently and cash conversion confirms both readings point the same direction. For a retiree needing dependable income, this is an industrial turnaround project, not an income sanctuary. And you are funding capital-heavy engineering execution with borrowed time on the balance sheet rather than collecting cash extraction. Turning next to OUE REIT, the trust's high-profile 500 million Singapore dollar asset divestment of the Crown Plaza Changi Airport Hotel dropped pro forma aggregate leverage by 5 percentage points. However, the trust's gearing compressed only from 41.5% down to 36.6%. At 36.6%, the trust remains in structural breach of our strict 35% S-REIT gearing ceiling, while interest coverage sits at a weak 2.6 times, well below our 4 times floor. This is why the zone verdict stays under review. The headline distribution yield is quoted at 6.19%, but the payout ratio runs north of 400%, a sign that a meaningful share of that distribution is not recurring rental income. My own sourcing has come back contradictory. One REIT says a fifth of the trailing payout traces to earlier divestment-linked capital distributions. Another says the most recent full year was entirely ordinary income. I am not handing you a forensic zone built on a coin flip, so this stays open until I confirm the ordinary-only figure against the audited annual report. And the 20 million Singapore dollar special distribution runway does not solve the underlying problem. Retaining cash for specials instead of crushing the deadline below 35% exposes the equity to higher refinancing risk, and the real safety threshold sits at 34.9% gearing, not the current 36.6%. Let's look at Singapore Airlines, which reported record-shattering passenger volume of 42.4 million, pushing revenue to an all-time high of 20.5 billion Singapore dollars. But net profit plunged 57% year-on-year to $1.2 billion, down from $2.8 billion. The balance sheet went the other way, with total debt falling to 10.6 billion and gearing sitting at a comfortable 24.5%, well inside my 35% ceiling. This is not a solvency story, it is a coverage and income quality story sitting on top of a genuinely strong balance sheet. The core risk factor comes down to the ordinary-only yield, which stands at 3.53% based on a 27-cent ordinary payout, failing both our 4.7% hurdle and the risk-free CPF special account 4% anchor. Jet fuel risks have structurally escalated due to the Middle East conflict. Because of the airline's lagged pricing structures, a 10% macro fuel spike will cause a 2.1% core margin compression, dropping the resulting ordinary yield down to 3.10%. Singapore Airlines is a classic peak passenger cycle trap. Mainstream media looks at the record 42.4 million passengers and assumes the dividend stream is unassailable. The uncomfortable truth is that ordinary dividend utility has already decayed to 3.53%, underperforming a completely passive allocation to your CPF special account, even as the airline's own balance sheet has gotten stronger. When you own airline equity here, you are taking heavy capital risk, operational leverage, and exposure to volatile jet fuel spikes for a yield that fails to match a policy-protected government account, which represents a mispricing of equity risk, not a mispricing of solvency. Some of you were with me back in May when we did the full earnings audit on this name, and Singapore Airlines sat at Zone 2 then, not Zone 4. I want to be straight with you about why that changed. In May, I was reading the total distribution yield, 5.58% specials included. That number technically brushed the edge of my Zone 1 threshold. But a special dividend is a one-time payout, not something you can build a retirement income plan around. And I have been tightening this exact test across every name I cover, including the banks. Strip out the special component here and you are left with the ordinary only yield of 3.53%, which fails my hurdle outright. Singapore Airlines has not gotten meaningfully worse as a business since May. My test got stricter, and it moved the same way it did for DBS and OCBC. One community, one forensic lens. In this market, the difference between a sanctuary and a yield trap is decided in a single trading session. While free subscribers are reading yesterday's story, Iggy's elite investors are already cross-checking the next setup together in real time. Members of Iggy's elite investors do not just get the report earlier, they get the full forensic picture the moment it is finalized. Zero-day breakdowns, the complete red zone watch list, and institutional-grade cheat sheets built around the same 5-layer audit you have just seen. The difference is they get it before the market opens, not after it has already moved. For 9 Singapore dollars a month, less than a kopi and kaya toast set at Raffles Place, you stop being the exit liquidity and start being the analyst. Join Iggy's elite investors today via the link in the description to secure your zero-day access. Turning to our final forensic verdicts for Step 4, let's start with Seatrium, which is classified as a secondary engineering turnaround with an outright fail for accumulation, transition, and drawdown suitability, placing it in Zone 5 red zone. This is a structural verdict, not a timing one. Yield fails the 3.2% floor. Interest coverage fails the 4 times floor independently, and free cash flow does not cover the dividend commitment. Seatrium's red zone status reflects genuine coverage and cash conversion weakness alongside the yield failure, not a strong balance sheet undercut by a single stubborn number. For OUE REIT, the formal zone assignment is withheld and remains under review pending verification of the distribution split, despite confirmed hard gate failures in gearing at 36.6% and interest coverage at 2.6 times. Singapore Airlines is classified as a national flag carrier, landing in Zone 4 caution, with a fail for accumulation and drawdown, and a conditional rating for transition suitability. My framework is deliberately conservative because our audience is managing CPF, SRS, and retirement income. This conservatism is a deliberate design choice to prevent capital impairment, not a limitation. The 4.7% hurdle is benchmarked against the highest quality guaranteed Singapore dollar yield available in the system, the CPF special account, rather than framed as a literal redirect option, since retirement sum ceilings limit how much fresh money can actually go there. For Singapore Airlines specifically, a Zone 4 verdict is a timing verdict, not a permanent rejection, because the balance sheet has room to absorb a dividend policy change, and the case improves if ordinary payouts rise or the price corrects. For Seatrium, that framing does not apply. A structural cash and coverage problem needs the underlying business to actually change, not just the market to reprice it. For members below the ceiling, the CPF retirement sum topping up scheme remains a genuine option worth understanding on its own terms. For a 58-year-old retiree in Dulk, drawing down SRS capital, buying into these headline-driven watchlists results in immediate income dilution today, with 2 of the 3 names carrying confirmed balance sheet or coverage weaknesses on top of that. Allocating fresh capital into a 1.52% turnaround asset like Seatrium or a sub 3.5% ordinary yield like SIA means trailing the core financial system anchors by real dollars every month, with no guarantee the gap closes on any fixed timeline. The mainstream watchlist is a structural threshold minefield, not a shopping list. I am Iggy, forensic investor, ranked 8th on Tiger Brokers among Singapore retail investors, and your guide through the SGX market jungle. If you want the full breakdown before the free version drops, Iggy's elite investors get zero-day access, link in the description. The window is already open. For just $9 a month, you stop guessing and start tracking structural realities before the macro shifts catch your retirement capital unprotected. Click the link in the description below to secure your place in Iggy's elite investors today.